Welcome back. We'll start getting our pre-open rates any second now. Asia has shown some recovery, though most of the regional markets are still in the red. Recovery because now Credit Suisse has gone ahead and officially borrowed that money. That's why the SGX Nifty is also holding on to gains of about 43 odd points. The first trades are in, and for the time being, it's a bit of red, 30, 40, 50 points down on the Nifty. Let's just quickly pull up some of the movers and shakers. IndusInd Bank, Bharti, HDFC Bank, ICICI. So some of the banks in the pre-open have started off on a soft note. Let's see how this plays out. And some of the IT stocks are on the upside. Well, as we wait for these rates to settle, let's look at Patanjali Foods. Exchanges have put a freeze on the shares held by promoters and promoter entities of Patanjali Foods over the failure to meet the minimum public shareholding norms. Mangalam caught up with Sanjeev Asthana, CEO of the company. Here's more.
We basically, the market conditions have to be conducive. And towards that, we continue to work. We are reasonably confident that this should occur in next couple of months. Investor meetings are already going on right now. Second issue I wanted to point out was that our shares in any case were under a lock-in till April of 2023. And otherwise, it's a very technical matter with SEBI. And the day we have the investors lined up, we can simply seek an approval from SEBI. And this will be granted immediately. So then we can do that. So it's a technical matter which we're trying to resolve, and we are pretty confident that we will be done with our 6% balance dilution in next couple of months.
Next couple of months, will that be done before April 23 when the promoter shareholding lock-in anyway ends?
Probably not. It may take more time because you do know that market conditions have to be more conducive. So that work is going on. And the confidence is that I would still keep it at a couple of months, but reasonable confidence that we would meet every single compliance what SEBI requires to be done. Our company is very confident. Our work towards business operations in terms of the management's commitment and everything remains. And this matter, we'll certainly get it resolved as soon as possible.
Right. Finally, before we let you go, what form of dilution will it be? Will it be promoter selling stake? Will it be fresh issue? Will it be QIP? What have you decided so far?
Most likely a combination of these. And the options are very much open with us, both in terms of the OFS and QIP. So probably it's going to be a combination of these.
You didn't think that it was the right time to do it when the shares were closer to around that 1500 mark, and then market conditions became unconducive? You were the right analyst for your business itself, right? Again, the question is, you all had 3 years.
No, 3 years was, you do know that COVID was a big impact factor, and almost for a year and a half, the markets were where they were. So once we did that, and issue is that we are pretty confident that we'll do better than what we did in the last time. So we are reasonably confident of the company's performance and where we stand. And I don't anticipate any problem with this.
Okay, that is Patanjali Foods and the clarification. But let's do one thing. Let's get back to the markets now. Looks like it's going to be a weak opening yet again. There's no respite to this, it seems. The Nifty is down 45 points and the Sensex in pre-opening is down about 330 points. But I guess that's the law of the land lately. So we'll see how it goes when we start off trade. Let's also discuss what's happening in the global markets with respect to the metal space. There's been a sell-off there. Amit Dixit, analyst at ICICI Securities, joins us now to talk about that. Amit, after the sell-off that you've seen in the global metal space, from the universe of stocks that you track, which are the ones that you would be cautious on now and which are the ones that you would avoid? Because clearly there is some demand, trend issues that are creeping up now because of perhaps the impending recession, all the global challenges. So how would you react to it, and what's the call on metals now?
Yeah, hi, good morning, Surya. So the issues that we have seen over last few days have been pertaining to the fears of recession, more to do with macros rather than micros. I would still say that China is shaping up beautifully. If you look at the demand data from China, the micro data from China, incrementally we are getting signals that things are setting up nicely. So typically the second quarter of the year, that is April to June quarter, is good in terms of demand in China, and we are seeing inventory drawdown both in terms of rebars and HRC. However, having said that, there is some bit of fear on the recession, particularly in the non-ferrous space. So the commentary on CAN front, for example, has been cautious. Commentary on the US front has been cautious. So clearly, we are more cautious on the non-ferrous space compared to the ferrous one. And if you look at the price action, so ferrous price action of late has clearly been a little bit more aggressive. We have seen price increases in China almost every month. So Bao Steel, for example, has increased prices for 3 months in a row. And Steel, the second largest producer in China, has increased prices just about yesterday for April sales, and Bao Steel is expected to follow the suit. So clearly China is shaping up nicely, and that bodes well for ferrous, I believe. And so despite the knee-jerk reaction that we saw yesterday, I believe that ferrous should settle nicely. Of course, macro risk notwithstanding, we believe that in case of metals, particularly ferrous, things look to be bottoming out.
Okay, and which stocks, Amit, good morning, in particular, in the steel side? And you're saying you can take a positional view and consequently positional trades and not look over your shoulder every time there's a bad headline from global markets. I mean, this is a space you can go long and stay long.
Yes, so if you look at the drivers, what we see that in steel space, in certain stocks in domestic space particularly, for example, JSPL, the thermal coal prices have been cooling off, which is good for JSPL. Coking coal prices have remained very stable, which is again good for the company. So I believe that this stock is very well placed. Tata Steel, for instance, again, the export market have been opening up. If you look at the differential between export prices and domestic prices, by the way, it has contracted to just about 3%. It was 12% last quarter, and export prices are well above $700. So clearly, the companies that are focused more on exports, again, JSPL comes to my mind, Tata Steel and JSW Steel, of course, with a big export component, are the ones who will benefit. So there are drivers for all the steel companies in the space. Mainly, if you talk about the order, JSPL followed by Tata and followed by the JSW Steel.
Okay, so that puts the picture out clearly on the ferrous side. Amit, morning. What about non-ferrous? Like you said, that's where things are a little more muddled. Copper, aluminum. Is there any point trying to play these trades? And what are the near-term fundamentals saying?
No, so I would rather play wait and watch mode on the non-ferrous stocks. The reason being that these stocks are typically more impacted by the macro or the Fed actions. So while demand supply fundamentals might be a little bit more, I would say, obscure in these stocks. So if you look at aluminium, for instance, if there were no, if all the restarts were there were not there in the Europe, you could see aluminium well below $2,000. So clearly, we have issues over there. And then as far as the downstream aluminium is concerned, clearly in the US market, in the developed markets, if there is a fear of recession, even if there is a fear of recession, and the commentary of the downstream producers such as end users such as Ball has not been very great. So clearly there is, we would remain a little bit cautious on this space at the moment, despite the stocks being at relatively good valuations. And valuation-wise, we don't have any regrets, by the way. All the metal mining stocks are trading at nearly 13 to 15% lower than their historical valuation band. If you see, they are trading lower than that. But we would stay a little bit watchful of non-ferrous stocks than ferrous.
Okay, watchful of non-ferrous, then ferrous. Got that. Thanks a lot, Amit, for joining in. Have a great day. That's on the metal space. By the way, finally, that confirmation has come through from DLF. I'm sure all of you remember that viral picture a couple of weeks ago where people were scrambling to purchase DLF's the Arbor project that they launched in Gurgaon. The flats are 7 crore plus each unit, right? And there was a viral picture saying that they sold 8,000 crores plus of worth of inventory in just 3 days. Those were reports, but now the management has confirmed it. So definitely the luxury market is booming, and the confirmation has come through from DLF. 8,000 crores worth of inventory sold in just 3 days, and that stock is up about 1%
Recession?
you guys-
Did anyone say slowdown, recession? I don't know what we're talking about.
Anyone feeling bad for themselves that they're not in this 7 crore plus? One day we'll be there. All right, Sudarshan, what about you? The 9-10 call this morning looks like it's going to be all over the place, and as you said, better to be cautious. But what's the big call at 9-10?
See, the big call is it's a good time to start investing if you have some surplus money. So JSW Steel and steel we just heard about is a buying opportunity.
JSW Steel is a buying opportunity. Mitesh, what about you?
I'll go with the buy on Berger Paints with the stop at 580 for targets of 615.
Okay. The other space we're focusing on is banks, right? All the talk has been about global banks under pressure. But what about Indian banks? And, there is no direct read across from what's happening globally. Abhishek is standing by. I think he's highlighting a Morgan report and some analysis of his own. Abhishek, hi, morning.
Morning, Prashant. So as you mentioned, banks have been under pressure. The bank Nifty in this year so far has declined by 9 to 10%. So individual stocks have declined anywhere between 5% to 16% levels. Top losers are SBI, decline of 15.7%, followed by Bajaj Finance, 13%, and Axis Bank, about 11.8%. Others who have fallen is HDFC Bank, about 5.3%, ICICI Bank, a little more than 7%, and Kotak Bank about 8.8%. So the valuations on a one-year forward basis has actually corrected, and now HDFC Bank is at 2.6 times. ICICI Bank on a consolidated book value is about 2.55 times, and Kotak Mahindra Bank on a consolidated book value is trading at just 2.6 times. Even the likes of Bajaj Finance, which used to trade on a one-year forward basis, price to book value multiple of 8 to 10x, is now trading at about 5.3 times. Now managements, they have been in various conferences and they remain bullish on the loan growth, despite saying that net interest margin will moderate next year. So we have had Morgan Stanley, who has written a note on management takeaways from various lenders. Lenders say that loan growth will remain healthy. Focus on higher margin book. That is the focus area that they are concentrating on. Net interest margin to moderate next year as funding cost will catch up. However, asset quality will remain benign. Retail term deposit is the area of focus for all the lenders. Back to you.
All right, thanks a lot for that. Well, in pre-opening, I just want to address one more stock, Reliance Industries. Now, I know it's been the biggest loser this year. It's underperformed the market, down 10% this year, while the Nifty is down 6%. But JP Morgan has, come out with a very interesting note where they maintain an overweight. They have a target price of 2960 on Reliance, which is well above the current market price. And they say that this is an attractive entry opportunity for investors if they want to get into it, because there are multiple catalysts that Reliance has over the next 2 years. There is the potential listing of the consumer business, which everyone's waiting for. There's the petrochemical growth. There is a large 5G capex monetization that they're looking at as well. And there is a ramp up in the new energy business, which is the next big trigger. So a lot of positive triggers. And let's not forget that the FII ownership of Reliance is now at a multi-year low. It's at a 6-year low. So they say that Reliance is now just 2% away from their bear case scenario, which means that this is a great time perhaps for long-term investors to be getting in. So whether that thesis plays out or not, time will tell. But interesting report from JP Morgan. Standard disclosure, of course, Reliance owns the channel that you're watching.
Absolutely. So let's see if Reliance can buck the weak trend. The other stock on our radar is Titan, which is actually up about 0.5% in pre-open. Mangalam, there's this interesting Lenskart deal. They've managed to raise a fair amount of money from ADIA. Does it have, can we draw any parallels, any takeaways for Titan's eye care business?
Well, that's exactly where my antennas went up as well, because this morning we got the news that ADIA has invested about $500 million in Lenskart. That values Lenskart around $4.2 billion, which is roughly 35,000 crores. The question is, could analysts start ascribing value to Titan's eyewear business? I spoke to a bunch of them. They aren't doing the sum of the parts or SOTP valuation yet. So basically, they haven't ascribed any value to this business so far. Just looking at Lenskart's numbers, FY22, which is public information, their revenues grew by 66%, around 1,500 crores, and they made a net loss of 102 odd crores. Assuming that on that 66% growth base, they do about 2,000 crores in this fiscal. This deal values the company at 17 times FY23 price to sales. Now, Titan, in the first 9 months, the eyewear business has done revenue upwards of 500 crores. Their profit making, the EBIT was close to around 96 odd crores. They've guided for 40% growth this year itself. So assuming they do 1,000 crores in FY24, the business at a much conservative multiple could be valued anywhere between 6,000 to 12,000 odd crores. So that could be some alpha coming in for Titan.
Okay, thanks a lot for that. So valuing the eye care business after what's happening with Lenskart. We have 30 seconds to go and the market is going to open anytime now. Looks like it's going to be a decent opening, but let's see. It's really been very volatile and the last few days have been trending lower. The Nifty is still indicating a open below the 17,000 mark. So key psychological levels have been scaled on the downside. That's the first tick on the index. Very, very quiet. But the important bit is that the broader market is still under pressure. The mid-cap index is down 60 points. Now the Nifty is falling, down about 25 odd points, falling rapidly actually. 35 points gone on the Nifty. Sensex down over 100 points. Not a good start. The Bank Nifty is sliding and sliding fast. So 120 points gone on the Bank Nifty, 140 now. So this is a weak opening. After yesterday's steep slide, no recovery at all. In fact, a lot of commodity-led companies are, falling the fastest. Hindalco, Tata Steel, JSW Steel, ONGC all under pressure, down about 1 to 3.5%. And then you have banks, Indices, HDFC Bank. So it's a steep slide that we're seeing across the board. Infosys, Tech Mahindra, no sectors spared really this morning. So banks, IT, metals are all under pressure as we speak. The headline index is not showing that much pressure because on the flip side, you have consumption, which is doing well. Asian Paints is up because of the fall in crude. Titan is up. Mangalam was just referring to that. Tata Consumer, Nestle, Britannia are all doing well. The domestic focused stocks are all doing well, the HULs of the world. And pharma. Pharma is generally the place to hide at, when the market is a bit cautious. So you have Divis Lab, Dr. Reddy's, Apollo Hospitals, Sun Pharma. That are all in the green this morning. Cipla as well is batting for the bulls. BPCL is up almost about 2.5%. So keep that on your radar as well. All the crude sensitives are doing pretty well this morning because of the fall that we've seen in crude. So now the market is stabilizing with about a 30-point cut on the Nifty. It is very volatile. The start is weak. The advanced decline ratio is well in favor of decline. So it looks like there is no semblance of sanity just yet. Just that the headline index is at the moment still below that 17,000 mark.
Yeah, that block trade on Motherson has happened. That's about 8% equity that has moved around, which is why that stock has started off about 7% lower. Last time I checked, 9% lower now. That is Samvardhana Motherson, so keep that in mind. Anything global facing is selling off. Metals is selling off with a vengeance. Your Nalco, Hindalco, Tata Steel, Vedanta. So metals are an absolute no-go area, as is banking. As Sonia mentioned, Bank Nifty is down about 0.5%. KPIT Tech, after yesterday's mega move, is seeing some profit taking. It's down about 2%. A lot of the mid-cap banks, IOB, Bank of Maharashtra, UCO Bank, Equitas, a lot of these names are on the downside of the screen. DCB is down about 3%. So that's where the money is coming off the table. Patanjali has started negative 3% lower because of their issues with the exchanges, with the promoters not meeting the minimum public shareholding norms. What else do we have for you? There's some weakness on Interglobe. There's no runaway move in the paint stocks, by the way. So if you thought that crude's cooled off and that'll lead to a big move on paint stocks, that's not exactly visible. It's not that kind of a market right now. And then there were the odd small stocks in news. Orient Paper, for instance, which is doing a capex. That stock's up about 2%. But otherwise, it's a very cautious screen. The mid-cap market's down about 0.5%. The Nifty is trying to hold up because now the fear trade is really happening. All these days, we were wondering why the money is not rushing to FMCG, which is your classic textbook fear trade. That's played out for the time being. Titan, as Mangalam pointed out, because of that Lenskart deal, is seeing plenty of traction, 1.5% up on Titan. So that's an interesting mover. But Prashant, once again, Asian screens tell you one thing, the SGX tells you one thing. The pre-open was telling us we'll start positive, but this is straight away a negative opening.
Yeah, but a flat start and then a 40-50 point fall seems better than open with a flourish and then giving all of it back. So this is, is mild, right? 30-40 points lower right now after the 800 points as the Nifty is given back. It's about 5% in the index in the last 4 trading sessions. So 16,946 is where we are at. Just a few other names before we go and introduce our market master of the day. Motherson, of course, we mentioned. Hindalco is steeply lower. I mean, actually, Amit Dikshit earlier was telling us that non-ferrous is not the place to be in. There, the picture is looking a little worse off. Steel is the place to be in. But for now, steel also is down on broader sentiment. Varun Beverages is down 5.5%. That's a big stock, meaningfully lower on volumes this morning. IndusInd Bank is at about 1,024, another 2% cut there. IndusInd has had a rough week. KPIT saw a big 7-8% move yesterday on the upside. It's down 2.25%, and I'm only mentioning it because it has volumes on it. Actually, the screen and right the word go is dominated by metal names. Lots of metal names, ferrous and non-ferrous. Bandhan Bank, again, another one of those which has had a rough one. It's down another 1.5%. Bank of India, Union Bank, I can see a lot of PSU banks which are under pressure as well. Market breadth is what? Over 2:1 in favor of decline. So losers outnumber gainers by over 2:1 right now. Policy Bazaars, a little one or two names on the upside. Policy Bazaar with a 3% gain at about 580. It's done nicely recently from the lows. HPCL with a big slide in crude is up about 3.5%. Maybe we could look at the stocks of IOC and BPCL as well. And there is Power Grid, which is like, one of those defensive names, 1.5% up there as well. Nothing large on the upside or downside on the Adani Group stocks this morning, which has been kind of what we've seen, at least over the last many trading sessions. It's generally quiet in that group. 35 points lower, it's neither here nor there. 16,940 or so is where the index is at. Vineet Samre is head of equities, DSP Investment Managers. He's joining us now. Vineet has been advising caution for some time. Past few occasions we've had him on the show, and it's played out. Vineet, thanks for joining in. At 16,940, how do you assess risk reward? And I'm only using the Nifty as a gauge to assess the broader sort of sentiment out there. Have valuations come off quite a bit or still rich? What's your sense?
Good morning, Prashant, and thanks for having me on the show. You're right. I think definitely at the higher levels, there was some amount of caution which was required. And I think triggers could be anything, but events typically follow. And with the, with likely what is happening globally, higher inflation, higher interest rate, I mean, those are basically just maybe the reasons for whatever we are seeing right now. So I think clearly we are in a very uncertain environment at the moment, and at the same time, like you mentioned, there is a lot of uncertainty. There is going to be more, sentiment-driven volatility in the markets. But it is very important to keep an eye on the valuations from the market's perspective overall. And when I actually look at the valuations and compare it to the 10-year averages, I think in the last couple of days we have seen the 1-year forward basis, the market valuations have come marginally below the 10-year averages, which is maybe a good starting point, let's say, from the long-term investment perspective. So clearly the markets are, in terms of the valuations itself, they have come down to, let's say, slightly reasonable level, maybe slightly more downside from here. They could be they may become even more attractive from the purely valuations perspective. So I think it's good to start looking at maybe nibbling some bit of investment at these levels from the valuations perspective.
Okay, by the way, a couple of stocks that do deserve mention. One of them is Dixon Technology. The management spoke to us a while back, and there was a change in their tone. For very long, they were talking about a slowdown in the mobile business. Now they are saying mobile business has picked up compared to what they saw in Q3, and they are hopeful of getting new customers on board very soon. So the stock is looking good. And the other one is Samvardhan Motherson. Surbi was also referring to that a while back. 9% lower now after that 4% equity block deal that happened. But a big gash seen on Samvardhan Motherson. Vineet, hi, good morning, and thanks for being with us on the channel. I wanted to talk about specific pockets, right, and what's happening there. I know there's no direct correlation of what's happening with the global banking turmoil and our own banking system, but do you see some pressure creep in? Because the banking names have actually seen a bit of an underperformance this year. PSU banks have also come off their highs. What do you do at a time like this with both private as well as PSU?
See, I think the reasons for underperformance has been clear. We have seen FIIs liquidating, the banking and financial stocks, and clearly the perspective is totally different. I mean, the foreign investors, they have seen, a lot of losses from their international trade, and India has been one of the markets where, they have not seen so much of cut. So this provides them a cushion in terms of, getting liquidity. And that has been one of the important reasons. Whereas if you see the fundamentals, I think today the banking fundamentals are at the best when we think about their growth, when we think about the asset quality, when we think about the profitability. And here's a scenario where the banking stocks are actually trading at lower than their average valuations if we compare it to the 5-year averages or 10-year averages. So from that perspective, clearly looking at the current business environment, what the banking business is into right now and the valuations, it makes sense to be overweight in the sector. But like you said, Sonia, there are some worries which are creeping in, and the worries actually stems from the fact that these banks are likely to become aggressive in terms of raising deposit. The deposit cost, as that goes up, that basically puts a cap on the profitability or the margins, and which is where some amount of let's say some caution arises when we are looking at the cost of capital actually going up. So in this environment, I would say that the banks which are able to, let's say, sustain the lower cost of capital or their deposit costs are lower on an average, I think those banks should do well. On the credit quality front, I think we are quite comfortable at the moment. It's environment, as I said, is uncertain. We don't know how things are going to shape up, but I think for India, it looks pretty okay as of now.
Okay, so Vinith, hi, good morning. If it looks okay for India, and then if we are able to sort of, cut out all the noise, then how do you go about deploying fresh capital? Would you advise people to, let's say, start putting in 25% or 50%? And which sectors? I think the common sense sort of approach is look at domestic-facing companies, stay away from anything that has global exposure. What would you advise?
So I would say that I think the near term really warrants us to look at businesses which will actually survive this, it's a global crisis which we are seeing right now. And it's very simple, actually. The P&Ls are uncertain today. The profitability is uncertain, but I think, and hence it is important to look at the balance sheets and investment more by looking from the balance sheet perspective would make sense from the near term perspective. And when I say that, what I mean is that businesses which are cash rich, which are less leveraged, businesses where the certainty of cash flow is higher, those are the businesses which will prove to be rewarding maybe this year when we go through uncertain time and when the profits are going to remain uncertain and predicting profits are going to remain uncertain. So I think that is one factor. In terms of how investors should actually think about investment, you're right. I think gradually they should start looking at investing some part of the capital, maybe 20-25% to start with, given what I mentioned, that valuations have marginally come below your 10-year averages. Maybe some amount of valuation attractiveness from here can investors can look to deploy more. In terms of the segments, I would say, I mean, it doesn't change a lot from what we were thinking for a while now. I think, as I said, healthcare has already seen the pain over the last 2 years, and we believe in the the mean reversion and cyclical recovery for that sector. So that's one sector which we like. Automobile, again, as I said, has gone through a lot of pain last 2-3 years, and there could be benefit which the sector can see from the cyclical recovery over the next 2 to 3 years. Beyond that, I think IT is a sector where there again, I would say, would be an opportunity going heading into the next 1 or 2 quarters as the world goes through some of this crisis. Maybe we get the IT stocks at reasonable valuation from where we are today. So I think broadly, cash-rich balance sheets, cash flow generating companies, decent ROEs, these would be the core principles which would drive the investments and segments where we would look at investing.
Mm-hmm. All right, Vineet, good hearing your thoughts. Thank you for joining in. Appreciate you taking out the time this morning. We look forward to the next one. Okay, so we are down about 0.5% on the market. That's the way this Thursday is playing out. Let's get to our next conversation then. James Sullivan, MD and Head of Asia Pacific Equity Research at JP Morgan, is with us now. James, good morning, and thank you so much for being with us today. We live in very interesting times, and just earlier on the program, we were talking to Jahangir, and he made an interesting point. He said, even if you get a soft landing, even in a soft landing, things still break. So with that context, how should investors look at equities here in India within the Asia-Pacific region? Do you think there's going to be a flight into some of these EMs because of what's happening in the West, or could it get worse before it gets better?
Good morning, and thanks very much for having me on the program. My good friend Jahangir always has very valid points to make. An additional comment or quote that I would pass on to you from Mike Ferroli, who's one of our senior strategists out of the United States, is every time the Fed hits the brakes, something goes through the windshield. And that's exactly what we're seeing right now. You have a series of embedded risks that have piled up in global markets that are now being brought to light through various mechanisms. And if we look at the United States, what we very clearly see, and importantly, is an idiosyncratic conversation where smaller US banks are exposed to a very different regulatory regime than the large GSIB or globally systematically important banks. That differential regulatory regime allowed for some of these risks to build up, and we're seeing the impact of that today. I do think it's important to recognize, however, that is a different regulatory regime than large US banks. And so you are starting to see a deposit flight away from small to large that will have an impact on overall levels of economic growth in the United States, which we have to take into account when we look at broader equity markets. But as we try to extrapolate those lessons here in Asia, again, they are somewhat specific to the US. I think some of the things that we can start to argue is that you will see a more rapid repricing of deposits. We are seeing that in markets inclusive of Singapore, where I'm based, and you're starting to see retail deposits earn higher and higher returns. That was expected. It's happening maybe faster than expected, but that was contained in many analyst forecasts. And so I think it's comfortable to say that the growth environment for a lot of the emerging markets has not significantly changed off the back of recent events. We are still positive on a series of country and sector level stories here in Asia.
James, hi, good morning. So then what is the read through? Is it just purely sentiment hitting markets like India, negative sentiment affecting PE ratios? And because as you say, there is no direct read across, right, from what's happening globally. And second point, on this Credit Suisse situation, can you tell us what's the house view? Will it be contained? Can it be contained?
So if I look at the flow through from the US into Asia specifically, again, we'll see a faster repricing of retail deposits. We will see some impact if we look at a potential slowdown in the US. JP Morgan numbers has about 500 billion in incremental loans coming out of smaller banks in the United States. If we assume all of those go away and are not replaced by lending from some of the larger banks, then that has the potential to create a drag on the US economy of 1%. And so again, per the conversation earlier in the program, focusing on more domestic demand, domestically oriented investments in markets like India, China, and domestic stories makes a tremendous degree of sense for us. If we look at the broader banking system as a whole, again, it's important to differentiate idiosyncratic risks from broader systemic risks. We are not currently seeing systemic risks to the global financial system. And so we're not necessarily sounding alarm bells from that perspective. If I look at a market like India or China, again, domestic demand plays remain very interesting. We are looking at financial services, which have underperformed, where we do see significant incremental potential for loan growth. And we don't see a significant pickup in asset write-offs as we look forward into the next couple of years. And so we're creating an interesting environment. The one thing that I would stress, however, relative to maybe some of the speakers earlier in the program, I do think it's incredibly dangerous to look at 5 to 10 year valuation multiples at the current time. And this is a mantra that we've seen in markets really consistently. And this is a very dangerous mantra from my perspective. Effectively, what you're arguing is that the world today is the same as it was 10 years ago. And I think it's obvious that nothing could be further from the truth. We went from a zero rate environment to a high rate environment. We went from a unipolar world to a multipolar world. There are many, many instances where the world of 10 years ago just isn't relevant to the conversation today. So when we're thinking about valuation multiples, JP Morgan view, and certainly my personal view, is that valuation multiples are relative to something. And so we've got to be very, very careful when we have that conversation in any market around the world.
Got that. By the way, I just wanted to, get our attention back to the markets because the sell-off is getting worse by the minute. The Nifty is now down 75 points, and we're not even 15, 20 minutes into trade. So it's not looking like a good start at all. We started on the back foot, and now it's sort of decelerating by the minute, barely hanging on to 16,900. That as well is gone. The Bank Nifty is down about 220 points. So this is not a good picture at all. But James, good morning. This is Sonia. It's good that you believe that perhaps we're not seeing any systemic risk to global markets. I remember we had a conversation in September of last year where you said that India is in a pretty good place compared to most global markets purely because of the resumption in GDP growth, and you were talking about growth of 6-7% as well. Does that still hold? Do you think India will continue to be an oasis in this desert? Because now there are some concerns emanating about growth as well, especially the domestic markets, perhaps because of the way the monsoon situation could pan out. What do you do with the Indian market at a time like this?
No, great question, and thanks very much for that. And I think we have to differentiate the short term from the medium term, the fundamental from the positioning data that we have access to. One of the things that we highlighted in a number of our conversations over the course of the last couple of months is the fact that India had become extremely well held, particularly by foreign institutional investors, had become reasonably expensive, particularly in the light of a higher interest rate environment. And we had gone neutral on the Indian market on the expectation that you'd see a pause in market performance, given the fact that most investors were already exposed to the market. What we saw late last year, earlier this year, was a very significant country rotation trade out of India into China as people started to play that China reopening trade. China had gotten very, very inexpensive from a valuation perspective, very, very underheld, particularly if you go back to last November time period, and you saw this country rotation trade into China. We still see what we would argue are potentially the last vestiges of that today. A number of investors are still playing a China reopening trade. In addition to that, you have an SOE restructuring trade ongoing in China today, where the regulatory environment is moving away from an EPS growth forecast and towards an ROE forecast. And you're seeing significant outperformance of safer dividend yield plays like the China telecom stocks at this stage. And so that's offering an alternative. From a medium-term perspective, we still do see very interesting prospects for India. And again, it all comes down to growth differentials relative to the region and relative to developed markets around the world. This year, we're forecasting that China GDP will bounce back quite aggressively off the lows of last year. As we look forward into 2024, there are very, very significant questions regarding the level of achievable GDP growth coming out of China. In that light, India looks very attractive from a medium-term perspective.
James, that's really interesting for us here. Can you expand on that? So as you look towards, the next couple of months into 24, calendar year 24, what parts of India would perhaps you look to play? Is it going to be domestic consumption? Is it going to be capital expenditure? Because the government's doing a fair amount of that over here. Some more thoughts, perhaps?
No, great question. And so again, it's the growth differential dynamic that we're looking at, particularly as analysts and investors start to roll forward their focus into a 2024 view. The elements of the India economy that are most exciting to us here at JP Morgan are primarily domestic demand and consumption plays. But to your point, you are also starting to see very selective CapEx programs from large Indian corporates. You had mentioned an upgrade that JP Morgan pushed through on one of those earlier in your program. Part of that story is the CapEx program that company is currently pursuing. And so if we look at the banking system in India, we are still positive. We have been for some time. The recent weakness offers potentially a medium-term buying opportunity. Domestic demand, particularly in the domestic consumption stocks, looks very interesting. And select CapEx plays off the back of corporate spending. One of the things that we got out of the Indian budget is that the infrastructure spending is there. It's not necessarily higher than expectations, however. So that is an incremental driver of infrastructure stocks is potentially a little bit more limited than what we would have liked to see.
James, very briefly, every day we get selling from foreigners. Data shows us that large amounts. You're saying primarily a majority of that is still going into cheaper markets like China on the back of that reopening? Or are we starting to see forced selling as well to make up for losses elsewhere?
So there definitely is evidence of some degree of forced selling, particularly given the degree of losses that some funds have experienced in the current levels of market volatility. The overarching story here, however, from a JP Morgan perspective, is one of a sector rotation away beginning last November from a very well-held, relatively expensive India market into an incredibly underheld, relatively inexpensive China market, as investors started to play that reopening trade, the end of zero COVID, and now this SOE reform trade. We don't see that necessarily lasting the farther we get into the second half. And the critical thing that we're trying to focus investors on is the very significant conversation that occurs when we start to move away from a 2023 view and move towards a 2024 conversation. The relative growth rates of India relative to China start to look very, very different on a 2024 basis.
Right, James, great speaking with you. Thank you very much for coming on, joining us here on CNBC-TV18 this morning. Interesting thoughts. Thank you.
Thank you.
Well, 90 points down now. This is an absolute slam dunk. At least it's turning out to be like that. 16,882. So we, of course, broke yesterday's low very easily. It was not as if we got a big bounce from yesterday's low, but that is gone. And we are at about 16,877. Metals, the Nifty Metal Index was up 2% yesterday, and that is suffering quite a bit right now. Banks are down about 0.75%, the Bank Nifty that is. So it's across the board pressure. Market breadth was negative, it's worsened, and that stands at about 5:1 in favor of decline. So broader markets are seeing a crunching time as well. We'll come back with the management of Maruti. Shashank Srivastava of Maruti joins in. As its parent organization, Suzuki Motor Corporation raises stake in the company. We'll talk to him about prospects and how he's seeing demand pan out. We also will speak with the management of Data Patterns. The company raised 500 crores via a QIP issue. Stay tuned.